Okay. So today's topic is analyzing statement of cash flows. You should be knowing that today what we are going to discuss is regarding the cash flow statements. Okay. And we are discussing about cash flow statements and also the direct method. How there are two methods with which you can make cash flow statements. One is direct method, one is indirect method. And you should be knowing both the methods. Okay. Now, the first thing is describe how the cash flow statement is linked to income statement and balance sheet. See, all the transactions which happen in a business in form of cash would definitely find a place in cash flow statement. Cash flow statement works on the concept of receipts and payments, and we call this as cash basis. But if you see the income statement, it works on the accrual basis. The difference between accrual basis and cash basis is here you record the transactions. Example, you record all the incomes when you earn rather than receive. That means if you earn the income, you can show in the books. There is no need for you to receive that. Okay. But when it comes to cash flow statement, when I speak about certain incomes, here only the incomes which you receive in form of cash can only be recorded. Same thing is applicable for expenses. Only the expenses here, like I will say, the expenses are recorded in the income statement when they are incurred rather than paid. That means payment you may not do today. You may do in the future. But when you take someone's services in your company, you are incurring expenses. So those expenses you can record in the books. Okay. Whether you are paying immediately or not is not given importance in case of accrual basis. But in case of cash basis, only if the cash goes out in form of any expenditure payment, then only it should be recorded. Okay. So you have understood these things. And now coming to cash flow statement, when you prepare a cash flow statement, they divide the cash inflows and outflows into three activities. One is the operating activities. So we call it as cash flow from operating activities, then cash flow from investing activities, and the third is cash flow from financing activities. So these are the three activities in which which are to be considered for the preparation of cash flow statements. We divide all the cash inflows and outflows from the business in these three categories, amongst these three categories. Okay. Now, so what they are saying here, an analyst can use the statement of cash flows to assess a firm's liquidity, solvency, and financial flexibility, including whether regular operations generate enough cash to sustain the business. Yes, it is very important for us to know the operating cash flows. If regularly the cash flows are generated in the business, then that will help the business to sustain. And we have to see whether firm has enough cash or not to pay its debts when they mature. That is what we are checking. That is what we are speaking about solvency. When I spoke about sustainability, I was speaking about liquidity. And whether the firm is likely to need additional financing should be seen, or some unexpected obligations if the firm is encounters, then what? Whether the firm can take advantage of new business opportunities as they arise, because for that even cash is required. Okay, just a second. Yeah. So we were seeing all this, and whether firm can take at, yeah, whether if see whenever you get some good opportunity to exploit, you also require cash for that. So you understand cash is very important, right? And I have already explained you that when we make a cash flow statement, we divide the inflows and outflows amongst these three activities. So here we make, this is a very simple and a very small format of cash flow statement. You will, start with operating cash flows, then whatever the investing and financing cash flows you have, if it is an inflow you will add, if it is an outflow you will subtract in case of both investing and financing cash flows. Then any change in cash balance you can see here, because when you add and subtract all these three, you will get a X amount. To that you add the beginning balance that should match with the ending balance what you show in your balance sheet. So I'll just write this all in figures. Let's say your ending balance. See, I am just framing a data. Okay, operating cash flow is 10,000. Investing cash flow is like, I got a positive cash flow 20, and financing cash flow I am paying some obligations, settling some obligations 5,000. So I have 25,000 with me. My beginning cash balance is 5,000. So my ending cash balance should always be 30,000. That then only the cash flow statement is correct. Okay. Now, so let's understand how to make the cash flow, how to find out the cash flow from operating activities. There will be a format. Let's see that. Okay, let's see some of the theory, some of the points what they have mentioned. See, earnings are considered to be very high quality when operating cash flows, which can also be called cash flow from operations, are close to or higher than reported earnings. Okay, at times this is very considered very high quality one, and cash flow from operations can be more or less than that. If earnings are consistently higher than cash flow from operations, their quality is lower because accrual based earnings are not backed by cash creation from operating activities. They say that if your earnings are constantly higher than the cash flow from operations, that is lower quality earnings, because accrual based earnings, okay, if you are following the accrual concept to calculate your earnings, right, are not backed by cash creation from operating activities. So there whatever the cash gets created because of operating activities, the accrual concept has nothing to do has nothing to do always with that. Okay, like when I speak about earnings, I speak about making an income statement. When I speak about operating activities, I speak about making a cash flow statement. Both are working on different concepts. Okay, like the statement of cash flows, income statement is a flow statement as it shows the company's performance between two balance sheet dates, that is the beginning of the year and at the end of the year. However, due to accruals concept, net income is not the same as cash generated by the company. Of course, operating cash flows and operating profit, or like ending cash flows and net profit at the end of the year cannot be same, because the concepts with which they are found out or calculated are totally different. In addition, many financing and investing cash flows do not affect the income statement at all at the time of transactions. For example, purchase of asset. When you purchase an asset, it is a cash outflow. But never you record purchase of an asset in income statement. Even though you purchase an asset, you directly write that in the balance sheet. So never this comes in income statement. Only purchase of inventories is what you write in the income statement, not purchase of asset. So that's what they are saying. Many of the activities like financing and investing cash flows, that means let's say you have raised some finance for your company, some funding in form of equity and debt. Those things will be reflected in the balance sheet. but never they will be shown in the income statement. That's not at all a part of income statement. Now, with respect to balance sheet, operating activities relate to the firm's current assets and current liabilities. So now I am giving you some idea. When you make cash flow from operations, cash flow from operating activities, you will also deal with changes in current assets and current liabilities in this section. Why? Because current assets and current liabilities are those which are to be, these are the ones, I mean to say, the current assets on which you expect economic benefits within 1 year, and these are the ones on which you have to you need to settle this obligation within 1 year, and they are related to your business operations. Okay, day to day activities, whatever you perform in your business, the current assets and current liabilities are involved, like collection of cash from customers, payment to suppliers, etc. So henceforth they come under operating activities. What comes under investing and financing activities? If you think, in case of investing activities, any kind of assets you purchase like plant and machinery, any kind of asset you sell, okay, that's disinvestment, but that is again a part of investing activities. If at all you have invested in some bonds or some shares, you receive income from them, like interest received from bonds and dividend received from stock, they also come under investing activities. And then when I speak about financing activities, it is related to raising funds like equity capital and debt finance, etc., and also repayment of debt at times. Okay, now, so that's what non-current assets and investing activities typically relate to firms' non-current assets, and financing activities typically related to firms' non-current liabilities and equity, which I've explained you right now. If you take investing activities into picture, all the non-current assets you would see in investing activities, and when you consider financing activities, all the debt, long-term debts and equity come under financing activities. Transactions for which the timing of revenue or expense recognition differs from receipt or payment of cash are reflected in changes in balance sheet accounts. So they are saying there may be some transactions which may happen. Uh, just a second. So I was speaking transactions for which the timing of revenue or expense recognition differs from receipt or payment. See, it's very simple. What happens, let's say I speak about salaries. Okay, 10,000. Let's say I have to pay salaries to my employee for the entire year. I made the payment to my employees for 10 months. So salaries, I would record 1 lakh. 10,000 is my employee salary. I need to pay how much to them? 1 lakh 20 for the entire year. I am taking their services, okay, and till the time till 10 months I also credited cash in their accounts. But last 2 months I did not credit cash in their accounts. Instead, I told them that I'll be making you the payment in the future, but I'm taking your services, I'm incurring the expenses. Okay, but how I'll show? Add outstanding expenses 20,000 and my total expenditure I'll show in the income statement as 1 lakh 20 and outstanding expenses will be a liability, right? So this is clear in case of accrual concept, but in case of cash basis, you cannot record these outstanding expenses in this year. You have next year when I pay them in the month of January, let's say January 15th, I'll be back from my trip. If I am not in India or not, I'm not running my company, I'm somewhere else. So I return on Jan 15 next year. So I'll be making them the payment on Jan 15 and henceforth that will be recorded in the cash flow, that will be recorded in the books. If I follow cash flow, sorry, if I follow the cash basis, if I follow the cash basis. So what happens here is, here the expenses are recorded in the year in which they have been incurred, but here the expenses are recorded in the next year, which is not a right treatment. It is understatement of next year's profits and overstatement of previous year profits. That is not good, right? That is not a right treatment. Henceforth, the big companies always follow accrual concept. So timing of cash flows, timing of revenue and expense recognition may differ from receipt or payment, because revenue and expenses are recorded when they are earned or incurred, but receipts and payments are recorded when they happen in actuality. Okay, that's what. So for example, when revenues or sales exceed cash collections, of course, what happens, let's say, uh, when you make income statement, you write sales, right? And you don't differentiate them as credit or cash. You write the entire sales amount here. Okay. So that is like 1 lakh is the sales you're showing, but in that 40,000 worth of sales is uh, credit sales. So you write receivables as 40,000 in your books. Okay. So what they say, transactions for which timing of revenue or okay, sorry. For example, when revenues, that is the sales, exceed cash collections. Now your revenue should be how much? 1 lakh. Okay. And your cash collections, cash collection, let's say the receivables are 40. The receivables are 40 and you only got 20,000 as your collection and still your receivables are 20. But in the books income statement, you are showing entire revenue as 1 lakh, right? See, 1 lakh is the sales. In that 40,000 is credit sales. In that 20,000 collected, 20,000 still to be collected. Okay, the still to be collected is again receivables, but you are showing the full amount in income statement as sales, right? Because there the concept what you are following is revenue is recognized when it is earned rather than received. That's what. So for example, revenues or sale exceed cash collections, the firm has sold items on credit, as I told you right now, and account receivable increases. I told you right now. Whenever you sell goods on credit basis, your receivables will increase. The opposite occurs if customers repay more on their outstanding accounts than the firm extends in new credit. Cash collections are more than revenues and account receivable decrease. Okay. So when you get collection, that's what it happened, right? So here, see, cash collection has increased and receivables have decreased by 20,000, correct? So customers repay more on their outstanding accounts than firm extends in new credit. Yes, at times it may happen. Old customers are also repaying you. Maybe so your cash collections are going high and your receivables are decreasing. Similarly, when purchases from suppliers exceed cash payments, that means you have made some credit purchases, okay, and you have purchased goods from your suppliers, okay, and the payment what you made to them is like let's say 1 lakh rupees worth of purchases you made, and you made a payment of 50,000 to them. So 50,000 is your payables, that increases your liability. And when cash payments exceed purchases, account payable decrease. That means when you make this payment, these payables, right? When you make 30,000 payables out of this, your liability will decrease and your cash will also decrease. Okay, that's what. It is helpful to understand how transactions affect each balance sheet account. For example, account receivable are increased by sales on credit. Yes, how much ever you sell the goods on credit basis, your receivables will increase. Yes, and they always are decreased when you collect money from your customers. Let's say you are receivable, you made some credit sales and 1 lakh rupees worth of credit sales you made. So your receivables are 1 lakh. Now you are receiving, now you have made credit sales, right? You will receive cash from your customers. Let's say 30,000 cash you have received. Now your receivables are how much? 70, and your cash account is showing how much? 30,000. So your receivables is decreasing, your cash is increasing. So now they are showing some relationship. Let's say uh, I will make a small account and tell you instead of this, but this also I will explain. I'll open a new book, new page. What they are trying to explain you. Let's say you have an amount at the beginning. Let's say 1 lakh is your receivables amount. That means this much you are supposed to collect from your customers. Okay. To this you add more amount in form of sales. That goes in income statement. This is already a part of balance sheet. Beginning account receivable you always see in the balance sheet. Okay, that means last year's account receivables you were supposed to collect from your customers was 1 lakh. Last year's closing balance becomes this year's opening balance. This year's sales are 50,000. Okay, and what happened is your ending account receivables is 30,000. What does it mean? 1 lakh, 1 lakh you were supposed to collect. 50,000 again you have sold the goods, you are supposed to collect. Okay, and 30,000 is what you still have to collect at the end of the year you are showing. That means how much you collected? 1,20,000 you collected. 150 you were supposed to collect, and 30 you are supposed to collect at the end of the year. That means from 150, 120 has been collected. That's the reason why 120 you are supposed to collect, you are showing. Okay, so we can make this in T-shape account also. So I'm making a receivables account. When I make a receivables account, here if I write anything in the debit, receivables are our assets. If I write anything in the debit, it shows increase in asset is always debit. These are the terminologies you should be knowing. Decrease in asset is credit. Always a credit balance. So when asset increases, debit. When asset decreases, credit. Okay. Now, beginning account receivable, I'll write to balance brought down here. Now I'm making sales. So when I make sales, that will increase my receivables, right? So I'll write sales here. When I do, okay, and this is my balance brought down, and here comes my balance carried down, by balance carried down. Okay, this you have understood, this also you can understand. So I already had a balance of 1 lakh, 50,000 worth of sales I have done. Okay, and like my ending balance I'm showing as 30,000. Okay, this is my receivables ending balance. So how much collections I made? 150, 150 from that 30. See, this is opening balance, this is closing balance. Clearly this you should know. Sales made during the year, sales will always increase your receivables. Only cash collections can decrease your receivables. So if 150 is what I'm supposed to collect, and I'm showing that at the end of the year 30,000 is what is my collection should be in the coming future, that means I have collected 120 out of 150 and 30 still to be collected. Okay, so this is cash collection. This is your balancing figure. Okay, now just you can see the example here. Just go through this example. Knowing 3 of the 4 variables, we can solve the fourth. If you know any of the 3, you can know fourth. If you know this and this, you can find this. If you know this, you can find this. Anything is okay. Okay. So for example, if beginning account receivable is this, ending is 15, like beginning I have 10, ending is 15, and sales I've done 68. So 78 minus 15, 63 is the cash collection. Okay. So you can do any in either ways. Now I'm giving you an example. Okay. Can you do this question? Okay, before that, we will also go to some other points. By rearranging this relationship, we can say that cash is equal to cash collection is equal to, we are just trying to see the relationship. Cash collection is equal to sales minus ending account receivable plus beginning account receivable. See, if you want to learn those formulas, it's upon you, or else if you are good with this, you can go with this. So cash is nothing but beginning account receivable plus sales minus ending account receivable, or beginning and ending account receivable you have to nullify, you have to add sales. Okay, or sales minus ending receivables plus beginning receivables. Please make a note of this in examination. When you do the what we say MCQs, it will be very handy for you. Fast. Now we are discussing some point, revenue recognition standards. See, accounting standards deal with all the elements of financial statements. So if you want to recognize revenue, there is a separate standard for that. So effect when a sale is recorded in the income statement. Yes, when you record some sales figure in your income statement, you are recognizing some figure as revenue, but not the timing of cash flows from the customer. That's what I said. When you record or write sales amount in your income statement, you don't show them as cash or credit. You just write the sales. Okay. Okay. That's the reason they are saying timing of cash flows from customer doesn't matter. Only if you are doing sales or if you are generating revenue, you record. Yeah, I understand. If the cash is not collected, it is credit sales. You should show that credit sales in the balance sheet as receivables. But if you see, I'll give you a very good idea. Sales we have done of 1 lakh. In that 50,000 is cash sales. 50,000 is, credit sales. So credit sales will be shown. Credit sales, if I make balance sheet, I will show cash as 50 in the cash account because that money I have received, and receivables as 50 because that I am supposed to receive. So in balance sheet, however, I am showing 1 lakh. In income statement, I am showing 1 lakh. So if a firm receives cash from customer in advance of sale being recorded in the income statement, that's called unearned revenue. That means they have made you the payment in advance. You are supposed to give them services. See, if you take Netflix or any subscription based services, first you make advance payment to them and then they give you services. Whenever you make advance payments to them, that is not their revenue, that is their unearned revenue, income received in advance. They can only recognize them, they can only recognize those. Okay, I'll give a small example. Let's say Mr. X wants to take a premise on rental basis and he approaches the landlord, and landlord tells Mr. X that okay, I'll give you the property on rental basis of per month 10,000 rupees. Mr. X says fine, I'll give you the entire money in advance. Okay, that is 1,20,000 he wants to give to landlord in advance. Now my question to you, this 1,20,000 is what for landlord? Is it a income or it's a liability? Please answer. Is it a revenue or liability? Please unmute your mic and try to tell me. Is it a revenue or a liability? Please participate. Don't think it will be wrong or right. Just try to tell. Say. Strange, I'm waiting. This is a liability for landlord. You will be shocked. Why? Mr. X has given advance payment to landlord. Landlord is supposed to still give the rental services to Mr. X. Till the time landlord does not give the rental services to Mr. X for the entire year, this particular 1,20,000 cannot be income or revenue for landlord. Okay, my point here, what I want to prove you is 1,20,000 received by landlord in advance is landlord's obligation or liability. The liability or obligation what landlord have is to give rental services to Mr. X. So what will happen? Jan 30th. Okay, Jan 1st, 2024. Mr. X has given the rental to advance rental to landlord. 1,20,000. Immediately that is liability for landlord. Income advance now becomes landlord's income, and landlord still has a liability of 1,10,000. Like that, when the year end comes, the entire 1,20,000 services, what services have been given to Mr. X, and then this 1,20,000 will become the revenue for landlord, and the liability will be zero, or unearned revenue will be zero. So that is the thing what I wanted to explain you. Okay. So cash received, but from the perspective of cash flow statement, that cash what you receive is your, you can show in the cash flow statement. Okay. So the cash received will appear in the cash flow statement at time of payment, not when the sale is recorded. So the landlord, if they follow cash basis, they need not wait for the entire month. For them, they receive the cash, that is their income. So for example, if a company provided a service agreement to a customer, the cash received is reflected in the cash flow statement when the customer pays for the contract. But revenue recognized in the income statement is spread over the life of the contract, which I said you. So if the landlord follows cash basis, the entire 1,20,000 is cash he generated, okay, and it's like income. But as per this 1,20,000 will become income only at the end of the first year when all the services for every month rental has been provided, okay. Every month rental service has been provided. Now there is a question in front of you. Please go to this question and try to solve. We'll try to solve. They're asking you, calculate cash received from customers in 2002. Come on, the question is in front of you. First. Now, Loftus Communications provide limited equipment sales and installation of telecommunication equipment. Loftus also provides maintenance for systems installed under service contracts. So what they do, they provide equipment, they sell equipments and installations also they do. And they also provide maintenance for systems installed under separate service contracts. Revenue from maintenance contracts is deferred and recognized over the life of the contract. That means deferred is what? It is income, unearned revenue for them. Deferred income means you will receive the cash, of course, but once they provide the services, then only they can recognize that amount their revenue. Selected financial statement data, Loftus Communication Limited, financial year, income statement, revenues are given, balance sheet extract, receivables, and unearned or deferred income is given. They are asking cash received from customers in 2002. So first we will take the opening balance. Cash received from customers. Okay. So we want to know cash received from customers, right? First, we will see what is the revenue. Revenue is this. Okay, that is for 2002 they are asking. See, your account receivable, previous, this is the current year, this is the previous year. We only have to focus on the current year. Previous year data for calculating the cash received is not relevant. See, this year revenue is what we have taken. It can be cash or credit. Okay. See, previous year your receivables were 5 lakhs. Now your receivables are 9 lakhs. Your receivables have increased. What does it show? Decrease in cash or increase in cash? Decrease in cash. Why increase in receivables is decrease in cash? Previously 5 lakh people were supposed to pay you. Now people are supposed to pay you 9 lakhs. You didn't receive money from them, but you have spent money for giving services to them. Or you have sold goods to them, equipments to them, for which you have spent money. So increase in receivables is not receiving cash, so it is decrease in cash. So it's decrease in cash, I subtract. Previous year your deferred income was this. Now your deferred income is this. This is a liability for you. The liability has increased. That means you need not pay now. See, previously you received this much cash for the services or obligations you were supposed to give. This year you took this much cash for the obligations which are supposed to give. Okay, you are not paying any cash from your hands. You are just going to give them services in the future. So when you are when this increases, previously they paid you 3 lakhs, now they are paying you 10 lakhs. Okay, the cash is increasing from 3 to 10, 7 lakhs. Correct or wrong? Yes or no? Please tell.
Yes, sir.
So increase in cash we add. So this is the revenue. Okay, and this can be cash and credit revenue. And this is the decrease in cash, increase in cash. All in all, when we adjust, the cash received from customers is this. Okay, make a note of this fast. See, revenue is just sales figures. Don't think it as cash in your hand. It has cash and credit, both the sales. So let's say the credit sales have been made, right? That is the receivables. So previous year receivables are this, now the receivables are this. Receivables have increased. When receivables have increased, that means you have done more credit sales. Okay, and that has decreased your cash. So we are adjusting it. And your cash you took this much and now this much more cash you took, we are adding. So hence the cash received from customers is this after adjusting everything. Out of 20 lakhs revenue, 4 lakhs increase in account receivable, that is decrease in cash, that will be adjusted because 20 lakhs has the credit sales amount as well. And then cash increase here. So cash received from customers. See, the increase in account receivable represents credit extended to customers, which is use of cash from firm's perspective. That means if the receivables are increasing, then what? You are not getting cash, right? You are extending credit to customers, which is a use of cash from firm's perspective. Use of cash means increase in account receivable. That means you are using goods to them, right? And increase in earned revenue represents services the customers have paid for in advance, a source of cash. They paid this much in advance, now they are paying this much in advance. They are paying 7 lakhs more, right, in advance. So it is increase in cash. Now we will discuss now the next topic which comes here is the direct method, which we are supposed to do. We will see what comes under direct method. Okay, direct method from cash flow from operating activities. The following are common components that appear on a statement of cash flows presented using direct method. So what you have to take in the direct method? Cash collected from customers, cash used in production of goods and services, cash operating expenses such as salaries, cash paid for interest, cash paid for taxes. All this will come under the direct method. And to calculate the cash flow from cash flows with direct method, you need to find out all these particular types of cash flows. You have to find out cash flow from customers, You have to find out cash used in production of goods and services, then cash operating for interest and cash paid for taxes. So these are the steps for direct method. So instead of looking at all this, I will explain you practically that one. You won't understand like this. I will explain you practically. So we can do that practically tomorrow in the fresh time, 8 p.m. around 8 p.m. And I will finish the direct and indirect method tomorrow. Okay. That will be the cash flow one. There are two chapters which are covered in cash flow statements. If tomorrow we finish direct method also, it's okay, because direct method is a very big topic to be done. Okay, so till that time, whatever has been finished till now, please go through that, and tomorrow we will very properly try to understand everything related to direct method. We'll solve a big question tomorrow and we will finish this. Okay, thank you.